Okay, let's go ahead and get started. And if we have a few people that come in late, that's perfectly fine, and I'm sure they can catch up. So, hello, everyone, and thank you for joining me today. My name is Teresa Pittman. I oversee strategic partnerships as well as direct business development at Payroll Centric. I've been in the payroll and professional services industry for over 20 years with no plans to stop anytime soon. This session is all about breaking down the Secure Act 2.0, specifically what it means for employers, payroll administrators, and plan sponsors. This law represents one of the most significant sets of retirement changes we've seen in over 20 years, and the updates impact everything from plan design to payroll processing to employee communication. My goal today is to simplify this complexity and give you a clear, actionable understanding of what you need to know and what's coming next. All attendees are muted, and I will accept questions from attendees in the chat box. I may stop a few times during the presentation to pause if there are any questions incoming, and then I'm also going to have a Q&A portion at the end. So with that said, off we go. Here's what we're going to cover today. And we'll start with a high-level overview of Secure 2.0, what it is and why it exists. Then we're going to move into some key provisions and their deadlines, focusing on what's already in effect and what's happening over the next few years. Next, we'll look at the payroll implications because this law requires real system changes to stay compliant. Then I'm going to share practical guidance for plan sponsors and HR teams with you. Finally, we're going to wrap up with resources and how Payroll Centric supports these compliance efforts. What is Secure Act 2.0? Secure Act 2.0, or the Setting Every Community Up for Retirement Enhancement Act, was signed into law on December 29, 2022. It builds on the original Secure Act of 2019 and expands access to retirement savings, increases contribution opportunities, and simplifies certain administrative requirements. The most important thing to understand, this law is a multi-year rollout. Some provisions are active today, while others phase in through 2027 and even beyond. Why Secure 2.0 was enacted, the four primary goals. Congress designed this law around four major goals. First, encouraging savings by increasing limits and adding new Roth options. Second, expanding access, especially for part-time workers and small businesses. Third, simplifying administration, reducing complexity where possible. And finally, creating new incentives like the Savers Match coming in 2027, which is really huge. And that's going to replace the Savers credit with actual federal contributions into participants' accounts. So let's review a couple of examples. So the 2027 MAGI, which is your adjusted gross income, is going to break down with this example here. So Sally is the head of the household. She is making, or she made $32,000, and that places her within the head household income band for Savers Match eligibility. Her $2,000 contribution yields a 50% federal match, resulting in a $1,000 deposit directly into her retirement account. Her income falls within the IRS-defined phase-out range, with exact step-downs determined by official IRS tables. Savers Match deposits real dollars into a retirement account, making it more impactful than the Savers credit that is replacing. Here's another one. So Larry worked 625 hours in 2024 and 510 hours in 2025, meeting the requirement of 2 consecutive years with at least 500 hours. 401k plans apply the rule starting in 2025, while ERISA-covered 403b plans have a 1-year IRS delay to 2026. Deferral eligibility does not automatically grant eligibility for employer match or profit sharing until standard eligibility, which is 1,000 hours, is met. Employers must carefully coordinate hours tracking with payroll record keepers to avoid compliance issues. The intention is to ensure long-term part-time employees can contribute without forcing earlier employer contributions. Let's begin with what's active right now. Many Secure 2.0 provisions are already in effect today, and employers should confirm compliance before focusing on future requirements. Here are the key provisions currently in effect. Automatic enrollment for new plans begins in 2025, but planning needs to happen now. Next, penalty-free emergency withdrawals allow participants to take $1,000 per year for emergencies without the 10% penalty. We also now have 529 Roth IRA rollovers capped at $35,000 over a lifetime if the 529 has been open for 15 plus years. And finally, required minimum distributions now start at age 73, and that's going to increase to 75 for individuals born in 1960 or later. So I think that goes into effect like the 2033, I believe. So lots of things in the pipe. So the super catch up. So this is super exciting. Beginning in 2025, participants age 60 through 63 get access to what's called the super catch up. It's a significant increase, the greater of 10,000 or 150% of the standard age 50 plus catch up limit. So it's going to be the greater of those two. This allows older employees to accelerate retirement savings during their final working years. Basically, it's enabling everybody to finish strong. So it's crucial for employers to confirm their plan document, and record keeper can support this future or feature ahead in present time and moving forward. Okay, I'm going to pause for a second. It looks like I don't have any questions right now in the chat. So with that said, I'm just going to continue going on here, and we can have that session at the end of the webinar. Major upcoming deadlines. Now we're going to shift to the two biggest upcoming milestones you need to prepare for: the 2026 mandatory Roth catch-up rule and the 2027 Savers Match. Both require advanced planning, especially on the payroll side. Mandatory Roth catch-up rule. This is the most operationally challenging provision for payroll teams. Starting January 1st, 2026, employees age 50 and older who earned more than the IRS wage threshold in the prior year, roughly $145,000, must have their catch-up contributions made on a Roth basis. So payroll must identify the employee's age, check prior year FICA wages, route the contribution to the correct source, and report those amounts properly on the W-2. And critically, if a plan doesn't offer a Roth option, high earners won't be allowed to make any catch-up contributions. That makes Roth adoption mandatory for these plans. And also going back here, the roughly 145,000, I have heard 141,000. So I think that has yet to be determined for the exact amount, but just to be safe, I would say 145,000, maybe 140,000, like just to flag those employees at this point. IRS good faith compliance period in 2026. So this is going to be a relief for many of you. The IRS understands this is a major change, so they provided a good faith compliance period during 2026. This isn't a delay, but it does recognize that employers may need time for full automation. To meet good faith standards, employees must be working with payroll vendors, amending plan documents, communicating the change to employees, and documenting the steps taken. Begin your preparation now. I always like to say, and it's been said to death, but it's a great time. When is the best time to plant a tree? 10 years ago. When is the second best time today? So this definitely applies to the scenario. 2027, the federal Savers Match replaces the Savers Credit. In 2027, the longstanding Savers Credit goes away and is replaced with the Savers Match, a direct federal contribution into eligible participants' retirement accounts. Match is deposited into a retirement account, not issued as a tax credit. So it's actual real dollars going into a retirement account rather than a reduction in taxes. The federal government will deposit up to $1,000 per eligible person, matching 50% of the first $2,000 contributed. This makes saving much more accessible to lower and moderate income workers. So eligibility is going to be based on your modified adjusted gross income with phase outs by filing status. So breaking that down, we had a question that came in earlier, as far as like what qualifies someone as low to mid. So I'm just going to break this down here that the single person is going to be in a range of $20,500 to $35,500. Head of household is going to be 30,750 up to 53,250. Married filing jointly is going to be 41,000 to 71,000. So obviously this will be in the content that I share with you, and you can also find that easily online. Secure 2.0 timeline at a glance. This timeline summarizes everything we've covered so far so you can prioritize planning, which includes the 2023 and 2024 changes, your 2025 auto enrollment and super catch up, plus your 2026 Roth catch up mandate and 2027 Savers Match. A lot of stuff going on here, right? So now let's talk about how Secure 2.0 directly impacts payroll systems and processes. For payroll teams, Secure 2.0 is not just a plan design exercise, it demands direct changes to how deferrals are coded, withheld, tested, and reported. The 2026 Roth catch-up mandate, in particular, requires significant system-level work well in advance of the effective date. Payroll systems must be updated to support Secure 2.0's logic. There are 4 core capabilities required: age and wage identification, correct routing of contributions, support for both catch-up limit types, and accurate reporting, of course. Automatic enrollment and default contribution payroll obligations. For employers establishing new plans starting in 2025, payroll must support automatic enrollment and escalation. This includes applying the default percentage, annual increases, opt-outs, and tracking each employee's rate. Reporting and documentation requirements for payroll. Secure 2.0 reinforces the importance of documentation. Payroll teams must maintain FICA wage records, eligibility reports, and auto enrollment tracking. And you can see here on this slide, it kind of breaks down a little more information around those 3 categories there for you. So I'm just going to pause here for a second in case anyone wants to read through this material. Again, this is going to be provided to you after the session today if you want to refer back to that. Okay, so let's move on here to the next section. So now we are at practical guidance for plan sponsors and employees. So we're going to shift into the actionable recommendations for plan sponsors and HR teams. Action items for plan sponsors. This is a lot of information on this slide too, so we're just going to go ahead and read through it here. So plan sponsors should prioritize plan design updates, payroll coordination, and reviewing amendments with ERISA counsel. What you should do now, you should confirm your plan document offers a Roth contribution option. If not, initiate an amendment immediately. This is non-negotiable for 2026 compliance. Review whether your plan supports super catch-up contributions ages 60 to 63 and update plan language and record keeper setup accordingly. If adopting a new plan in 2025 or later, design it to include an automatic enrollment and escalation feature that meets Secure 2.0 minimums from day one. As far as your payroll and vendor coordination, here's a breakdown of recommendations. You want to engage your payroll provider and record keeper now to map out the system changes needed for age wage-based catch-up logic. This is a multi-system build that takes time. Request a readiness assessment from your payroll vendor specifically addressing Secure 2.0 Roth catch-up capabilities and their implementation timeline. So this would be a really nice resource for you to have on hand that your payroll provider can supply you. Schedule a plan amendment review with your ERISA counsel or TPA to identify any gaps requiring formal amendment before required deadlines. Communicating the Secure 2.0 changes to employees. So again, like a lot of information on this slide that you can refer to at a later time, but it is broken down, for an easy overview. But clear communication minimizes confusion. Here are your key groups and what you need to make sure they understand. The higher earners are going to need to advance notice of Roth catch-up changes. Your lower earners should understand the upcoming savers match, very important. And your new hires need to understand the auto enrollment regulations. Resources and how payroll-centric supports your compliance. Here are resources for staying compliant. Payroll-centric supports compliance by building wage and age logic, routing contributions correctly, generating reports, coordinating with record keepers, and tracking amendment deadlines. How we can help. Payroll-centric will build a wage plus FICA wage test required by the Roth catch-up rule. We automate Roth versus pre-tax deferral routing based on each employee's eligibility status. We generate compliance reports for plan administrators confirming deferral type and eligibility documentation. We coordinate with your record keeper and TPA to ensure data consistency across your systems. Finally, we help you track and meet amendment deadlines before IRS imposed cutoffs. Any questions here? Be sure to contact your payroll-centric representation or representative to schedule a Secure 2.0 readiness review. Now, if you are currently a payroll-centric client, you would want to reach out to your account manager who assists you and supports you with your payroll processing. And if you are not currently a payroll-centric client, feel free to scan the QR code at the end of the presentation to reach out to us, and we will get back to you promptly. And as I mentioned, that was the QR code. So again, you can scan this. I'm just going to pause here for a moment so you can scan that information if you choose to do so. And also, I'm going to open up the chat for any questions that any of you may have. So here's a question. What's the difference between the Savers credit and a new Savers match coming in 2027? So we touched on this, and basically it's going to be actual real dollars that are going into a retirement account as opposed to taking tax off at the end of the year when tax filings are made. So great question there. Um, and then another question is, how does this affect state-sponsored programs? So, Cal Savers is a really great example. So, how is it going to affect the state programs? So, the answer to that is it it really doesn't change anything. They meaning the the federal government and financial planners in general are anticipating that it's really just going to shift the way people um, place their retirement funds. So it's nothing is going to change with your state sponsored programs at this point in time. However, it is anticipated that it's going to shift like how people invest their money and where they invest it, especially with the federal match. That's a new thing, and that's a really great incentive. So just look for some habits to shift if you're in a state where you have mandated state-sponsored programs in place as well. Okay, so I don't see any other questions coming in. It looks like you folks are going to get some bonus time back in your day, so that's always nice. But I do thank you for your time today. As a reminder, we're going to provide you with a recording from today's session. If you'd like to explore Payroll Centric and how we can support your business with the new retirement regulations or any of our other services, scan that QR code and we're going to reach out to you right away. So thanks so much again. Look for other topics that we will be conducting with our webinar presentations, and I hope that you can attend. Thank you.